Everyone, Adam Bergman here, IRA Financial. And on today's video, passive rental real estate and your IRA. So got a really interesting video for you today with the markets being crazy, equities, cryptos, even precious metals being down. I got a lot of inquiries from clients who wanted me to talk about real estate. So I wanted to do a video and discuss from a tax attorney standpoint, the difference between passive and active real estate and your IRA, some tips and things you should consider if you're contemplating using an IRA to buy real estate. So first things first, obviously we know real estate could be passive or it could be active, right? Millions of Americans own real estate passively. We'll report that on Schedule E as an Edward. And then there's millions of Americans that have an active real estate business, where they either have an LLC, corporation, or Schedule C as in Charlie. But let's focus on retirement accounts. So when an IRA buys real estate, there's two ways to do it. And I'm actually going to kind of map this out right here. So the first way to do it is just where the IRA will own the real estate directly. Okay. And that is known as just a standard IRA or a custodian IRA. Okay. The second is something known as the checkbook control, where the IRA will own an LLC. Okay. And these are two ways that you can buy real estate. And excuse my handwriting, that's why I became a lawyer. It was either between law and medicine, and I don't really love blood, so I chose law. But you can see the difference between the IRA and the checkbook control is the IRA invests directly in the real estate, in the standard or custodian IRA. And two, with the checkbook IRA, the IRA owns the LLC, and then the LLC holds the real estate. And by doing the LLC, you have what's known as checkbook control. So you can, as the manager of the LLC, so the IRA owner is here, and he or she could then use a bank account to do investments. So checkbook control gives you number one, limited liability protection. The LLC will protect the assets outside of the LLC. It also gives you more control because the IRA owner, you can make investments by writing a check directly from a bank account. And thirdly, you have more privacy because the real estate is not titled in the IRA, it's titled in the LLC. So you can call the LLC XYZ LLC or ABC LLC and have more privacy and anonymity. So when you own real estate passively, there's two options. The LLC is becoming the more popular option for many real estate investors who want more control. We're going to be doing more investments, high frequency of investments. The real estate LLC makes a lot of sense. If you're just doing like a one-off investment into a fund, or maybe you're just going to own some land and not going to have rental income or a tenant where you're going to have to do things with respect to paying expenses, things like that, the standard IRA, the custodian controlled IRA makes a lot of sense. But if you want more control and going to do a high frequency transactions, the LLC makes a lot of sense. So once you've decided what you're going to do, now let's talk about activities, whether your activity is going to be passive or active. And I'll explain in a minute why that matters. If you're just doing passive investments, again, through regular IRA or checkbook LLC, you're not going to have any tax, right? The beauty of using an IRA to make investments is all income generated is tax deferred or tax free in the case of a Roth, meaning the rental income and the sale of the asset will be without tax. Now, if your activity rises to the level of a trade or business, then it's not passive. And what does that mean from an IRA standpoint? Being an active business from an IRA standpoint is not good. Okay. Why? Because now the income from the passive activity, which would be tax deferred or tax free in the case of a Roth, will potentially be subject to what's known as the unrelated business taxable income tax or UBIT tax or UBTI tax. And that's a tax that's imposed when three things happen in an IRA. And only two is relevant to real estate. The first is margin to buy stock, which is not relevant to real estate. The two that are relevant is number one, there's a non-recourse loan to buy real estate. That's a loan you do not personally guarantee. Why? Because you cannot personally guarantee an obligation in your IRA under 4975C. So if your IRA uses a non-recourse loan to buy real estate, you may be subject to the UBTI tax based off a debt finance portion of the income. So if you put in 100K and you borrowed on a non-recourse basis 100K, 50-50 debt to equity ratio, that means 50% of the net profits could be subject to the UBTI tax, which can go as high as 37%. So UBTI is not good, okay? You do not want to be in the UBTI world, okay? Not good. So UBTI, again, non-recourse loan to buy buy real estate. Now, let's say you're not using leverage, but you're going to be doing active real estate. What's active real estate? Well, I'll get to there in a minute, and there's some case law that we can discuss. But number one thing to consider is if your activity rises to a active trader business, the UBTI tax can apply and then jump 37% tax on the income. So generally, if the income is passive, if it's deemed passive, there's no tax, right? Unless there's a non-recourse loan. But assuming no non-recourse loan, passive real estate, which most real estate investors are involved in passive real estate, you're not going to have any UBTI tax, and you can then benefit from the tax advantages of using an IRA to buy real estate. But what happens is the activity is active. So what determines if the activity is active? Well, I'll give you the lawyer answer. It's based off facts and circumstances. So no one, not me, not a tax lawyer, not the greatest tax lawyer in the world, can tell you what will determine whether an activity is guaranteed to be treated as active. There's factors based off certain case law. I go all the way back to the 50s, 60s, and 70s to talk about what factors the IRS would look at to determine whether a passive real estate activity could be deemed active. And I'm going to summarize them for you here. So number one is frequency, right? Obviously, the more real estate activities that happen here, the better chance the IRS could argue it's active. So if your IRA, for example, invests and builds 45 homes, that looks a lot like inventory. That looks active. Okay, so frequency. How often are you building and buying these homes? Is it every 6 months? Are you starting with 20, 30 homes? So that's one factor. What's your intent? Are you intending to have a business, or is the intent passive? It's another factor. Third, what do you do personally? Are you a doctor or are you a real estate developer? It's another factor that the IRS will look at to go towards the intent. You're a real estate developer, so you're building 3, 4, 5 homes. That is maybe an easier argument to make that you're an active business versus a doctor or a lawyer just, kind of owning 1 or 2 homes in an IRA. Okay. How much improvements are you doing? Are you buying a home or building a home? If you're just buying a home, maybe putting in 10, 15 grand, maybe some new landscaping or a pool. Okay. Versus, literally demolishing a home and rebuilding it. Okay. Now, 1 or 2 homes, no one, and I'm saying no one in the IRS will argue you're in business. I have competitors out there. I've read blogs, videos, saw videos, podcasts where some people will say, well, if you just do 1 or 2 homes, you could be deemed a business. No, it's not true. Okay. There's safe harbors under section 199 where you can automatically, positively, proactively take the position you are a business. But if you're not availing yourself of those safe harbors, you will not automatically be deemed a business. Okay. So 1, 2, 3 homes in a year, you're probably not deemed a business. Okay. You're going to need to show, again, frequency, intent. You're going to have to show what type of improvements you're doing, the duration of time. Are you buying a house and flipping it the next minute? These are all the factors the IRS will go into looking. Now, number one, they'd have to audit you, right? So if, let's say your IRA flipped 3, 4 homes in a year, and you take the position as passive, right? Because you're a lawyer, or a doctor, or a business person, or a nurse, and this is clearly an IRA investment. You have other IRA investments. This is just part of your diversification play. And clearly you take the position it's not a business. They number one have to audit you. Then they would have to somehow understand what you've done and then knowingly argue UBIT. Again, not a prohibited transaction. UBIT is a tax. It's not a prohibited transaction. It does not disqualify your IRA, but it could impose a pretty punitive tax of 37% on income that should be deferred. So it's not something to take lightly. But I'm telling you, as a tax attorney, someone that's been in this space 12 years, someone who's practiced law, 20 plus year, if you're doing 1, 2, 3 flips in a year, you're not going to be deemed a business. Okay, the IRS will not be successful to argue your business, especially if you can show that your IRA owns stocks, it owns gold, it owns other stuff, and this is just part of your investment strategy. But if you are building 10 homes in a year, or you're investing in a development that's going to have 20 or 30 homes, yeah, there's a good chance the IRS could argue it's a business. Okay, how do you know? Right, that's the next question. Now, clearly, if you're in control of the development project, you're building the 1, 2, 3, 4 homes, it's up to you to take the position whether it's passive or active. And I'm telling you, under 5 homes in a year, it's awfully hard for the IRS to argue that your IRA is in business. Okay, 10, 15, yeah, that looks a lot like inventory. It looks more like Target selling T-shirts or soap. 1, 2, 3, 4 homes, it's going to be awfully tough. An argument could be made, right, based off those factors I mentioned: 10, frequency, duration, proximity, also what you do personally. Now, an argument could be made. I just don't think they're going to be successful. And generally, the IRS does not like to audit IRAs. There's no specific IRS audit division. IRAs get audited through the SBSE, Small Business Self-Employed Division. And the IRS doesn't like to audit transactions that aren't slam dunks. So anytime there's facts and circumstances and the law is clearly not on their side, more likely than not, they will not pursue cases because it's going to be time consuming and there's limited reward at the end. Again, it's just UBTI tax, right? And guess what? You may have been entitled to deductions from previous years if you had expenses associated with that property, depreciation, things like that. So it's unclear how great the reward would be for the IRS. So this is an area they generally do not like to tackle. But we want to protect ourselves. We want to make sure that we have the best supporting facts we can have as a showcase in case the transaction does get audited. We want to be able to show that this is passive and not active. So again, those are the factors to consider. If you have funds, you want to show that, hey, I'm doing some real estate, but I'm also doing stocks or maybe cryptos or gold. This is all part of the investment strategy. So let's say you flip a home. I suggest to clients, hey, put that money in the market, right? Diversify it. And then when you want to buy a new home, move it out, right? And leave a little in equities. You want to diversify. You want to show the IRS that, hey, real estate is not the business. It's just part of my passive investment strategy for my IRA. So what about funds, right? Let's say you invest in a real estate fund. You're not running the fund, right? In your mind, this is a passive investment. I'm not a real estate expert, right? I'm not doing any of this. What is the deal? So because you're doing this passively, let's kind of map it out, right? So your IRA invests in a fund, okay? Real estate fund, and it's going to have lots of other investors, right? It's going to be lots of investors. You're not involved. You're just an LP, limited investor, okay? You're not the general partner. You're not running the deal. How do you know what's going on here? Do you know there's leverage, right? Do you know if there's a loan? If there's a loan here, and this is a pass-through entity, the UBTI tax I talked about on investing in a investment fund or a pass-through entity with leverage could trigger UBIT, okay? Is this deemed an active business, right? What are they doing? A lot of times you don't know. The only way you're going to know is through the K1, okay? When you get a K1 from and again, my handwriting kind of sucks, so I'm sorry about that, but I wanted to kind of visualize it for you. The K1 comes with the 1065. So you invest in an investment fund, a real estate fund, you're going to get a K1 at the end of the year, or your IRA will, and it's going to show what type of income. It's going to show line 1 if it's business income. If that's the case, it's going to be hard to argue to the IRS it's passive because it's right there. It's business income. But if it comes in as rental income, if it comes in as capital gains, interest income, things like that, then you have a good case to argue that it's passive and not subject to UBIT. Of course, then the issue is, okay, I know it's not an active business because the K1's telling me it's passive. Is there leverage? And that's when it becomes tricky because, there's subscription docs and they kind of disclose the investment strategy, but you may not know there's leverage. You can assume, right, most real estate funds do use leverage, you may not know. So how do you report it, right? Now, this is the next thing. generally on the K1, if there is UBIT, if it's a larger fund, they will report it in the K1, and there's a specific code, U or V, they keep changing it in box, I believe, 21, where they will disclose the UBIT. So if it's not a big fund, they may not disclose it for you, and then you'll have really a difficult time to unearth this. So it's generally in box 20 where it says other information. And that's where you're going to get a code that, hey, we have triggered UBIT, and now the IRA is going to have to report it. But I've seen this, okay? Again, I've been doing this a long time. I've seen it where the smaller funds do not report it, okay? And if they don't report it, then it obviously makes it quite difficult for the IRA to report it because you don't have that type of information. So if you don't report it and it's not on the K1, how's the IRS going to learn about it, right? And that's the issue. In most cases, it does go unreported because it's not on the K1. And if it's not on the K1, the IRS doesn't even know to look for it. Okay, so just something to consider, something to keep in mind. But I wanted to break down this video again. There's kind of two ways of looking at UBIT. If you are the one that's managing the investment, meaning you're building the home or you're flipping the home or you're buying the land, then it's up to you to determine whether it's passive or active. And again, you're doing under 5 homes a year or under 5 transactions involving the IRA, I would not worry about UBIT. Yeah, you need to look at the elements, case called Adams, where again, frequency, intent, your duration between investments, the amount of improvements, all that stuff matters. Agreed. But going to be awfully hard for the IRS to argue you are in a passive, or you're in a real estate business that you think is passive, but we think is active if you're just doing a couple transactions a year. It's very hard to show that's inventory, especially if you have your IRA, other IRAs invested in other assets like equities, because then an argument can easily be made, but this is part of my investment strategy. Even if you're just kind of rotating homes 3-4 times a year. Most IRA investors cannot flip more than 4 or 5 homes a year. What about paper, right? What else? You're just flipping real estate contracts. Again, that's even more passive, right? That looks like stocks. So I just want to make this clear. When you buy and sell stocks, that's probably the most passive you can be, right? So clearly you can buy and sell more than 5 stocks a year. You can do hundreds of thousands probably, right? It's going to be awfully hard for the IRS. If you're not taking the position your IRA is in business, which you wouldn't, you may want to take the position personally to get deductions from your investment strategy. But if you're just buying and selling stock in your IRA, there's no case law out there. It's going to be impossible for the IRS to argue that's an active business. So that's on one end of the spectrum. Real estate development's on the other end, because that's certainly more active, right? You have equipment, you have workers, there's things going on to build a home, okay? So if you're building 10 homes, that's probably active. If you're buying and selling stocks, that's passive. Now in the middle are the, hey, I'm flipping a couple homes in a year, you're good. Flipping 10, 15 homes a year, ooh, a little gray. What happens is just flipping contracts. I got a lot of clients that just flip real estate contracts. Super smart. They get a contract, they have someone they want to buy it, they flip the contract. That's even more passive, clearly, than real estate development. That looks a lot more like stock. In those cases, you probably can get away with doing more than 5 to 10 in a year because the activity is so passive, right? You don't need to hire landscapers and put a pool in and have construction workers and do an architect, all that stuff that makes it look more like a business. By just flipping contracts, it looks a lot more just like selling and buying stock. So you have probably more flexibility on that end. Now, on the investment fund side, it's a little bit more difficult to understand if UBIT applies, especially if the K1 doesn't disclose it on box 20. If it doesn't have a little code in there, again, I think it's U or V, and it will say it. If there's nothing in there, there's no way you're going to know there's UBIT. Now, even if there's leverage, even if you 99.99% you know this fund is using leverage, how are you going to be able to figure out UBIT, right? You don't know what the leverage percentage is. You don't have the accounting. There's no way you can report it. You can ask your GP, but they may not provide it. They may say, hey, that's your problem. That's not something we do. And I've seen that. It's a catch-22. And then you're kind of in a difficult position where you kind of believe there's UBIT, but you can't report it because you don't have the figures, right? I gave you an easy example. You put in 100K cash, you borrow 100K, 50-50 debt to equity ratio. Let's say there's $20,000 of net real estate income after expenses, depreciation, and the like. Half of that, the $10,000 will be subject to UBIT, right? The 50-50 debt to equity ratio, 50% debt, 50% equity. You multiply that ratio by the net income, you'll get the amount subject to UBIT. When you got a fund with hundreds, maybe investors, it's a lot more difficult. Okay. And if you don't have those numbers, you're not going to be able to figure it out. No chance. You don't have access to the books and records, and you're just not going to be able to do it. So you're not going to report it. And if you're not reporting it and it's not on the K1, there's probably no way the IRS will even uncover it. Even if they audit the fund, they then have to look at who the investors are and then decide and determine whether one of these IRAs even reported the UBIT. And you got multiple IRS departments in there. It's not going to happen. The money's too small, right? Let's say you invested 100 grand, 200 grand, and the net income is 30 grand. The 37% on the 30 grand is 70 grand. It's not worth the IRS's time. Okay, even with interest and penalties, it's peanuts. So the stuff just doesn't get reported. In a lot of cases, you have a good defense from the investment fund perspective because there's no way, since you're not the GP, that you would have access to those to that information. But again, moving to the situation where you're involved, where you're buying and selling land or flipping contracts or buying and selling homes, you have obviously more of the determination. And again, I think I would take the position, anything under 5 in a year, I wouldn't worry about, honestly. Over 5, I would speak to us if you're a client of IRA Financial or a tax advisor if you're not, and get their thoughts on some of the case law out there in terms of how it could apply to your situation. It's very facts and circumstances heavy. Okay, so my facts are different than your facts, and the conclusion based off my facts could be different than yours. So that's why it's important, I believe, to work with a company like IRA Financial. And yeah, I'm clearly not objective, right? But I do believe in what we do. With 23,000 clients and our expertise in the area, we've seen it all. Okay, and I've written 8 books on self-directed retirement accounts. So I've spent my time in the library, quote unquote, researching this stuff, and this is what I do. It's my passion, and with pretty good connections into the IRS, I'm able to get some feedback off the record in terms of what an agent thinks in terms of whether this could rise to a business or from a UBIT perspective. So that's something that I will do for clients that are kind of wanting a little bit more guidance. So this video is really just kind of introduce the concepts for between passive and active IRA investments. I do wish there was more of a black and white answer, but with law, it's gray. I mean, there's no black and white answers. Even if the statute said something, there's always wiggle room. Okay. So in this case, there's case law. There's not really much of a statute other than passive types of income involving IRAs like capital gains, rental income, real estate income, royalties, interest, dividends are all passive and not subject to the UBIT tax. That's why 95% of Americans never heard of UBIT. If you're just buying equities, mutual funds, ETFs, you're not doing anything involving leverage and real estate with pass-through entities, you're not going to be dealing with UBIT. 99% of all corporations are C Corps. So I want to just make this point crystal clear. Okay, because you may be sitting here saying, Adam, I own Tesla stock, I own Apple. Like, what the hell are you talking about? It's a pass-through entity, it's a business. I've never paid UBIT. Am I in trouble? No. 99% of all public companies are C Corps. Okay. Think of a C Corp as a big box, right? The income gets trapped in here, right? And there's a 21% corporate level tax, right? So there's a tax here, and there's a tax on dividends. Okay. So we see that. Now think of an LLC as like a funnel. Okay. So the income just kind of flows through up here. There's no corporate level tax, right? So it doesn't get trapped here. So if you invest in an active business through a corporation like Tesla or Apple, Facebook, Meta, there's a corporate level tax, so there's no reason for the UBTI tax to apply because it's already being taxed. But on a flow through entity like an LLC, restaurant LLC, bar, or whatever, there could be a reason for the UBTI tax to apply on net income above $1,000 because this income is not being tracked. And the whole point of UBIT is the IRS back in the 50s, and I've used this example a million times, did not want charities to restaurants or businesses, I should say, any for-profit business, they didn't want them to set up charities and run their business through a charity and never pay tax, right? The fear was, hey, if Ford or McDonald's just set up a charity and ran their business operations through the charity, they never pay tax, and they would use the tax-exempt status to get around the tax. So what they came up with was a system called unrelated income to say that, hey, if you're a charity, like a hospital, and you have unrelated income, meaning you sell hamburgers, French fries, we're going to tax you on that income because it's unrelated to your exempt purpose. Selling hamburgers isn't related to the purpose of keeping people healthy and helping people with sicknesses. So unfortunately, IRAs are treated and taxed like charities under 501, but IRAs don't have an exempt purpose, unlike a hospital or a Red Cross or some other charity that has a specific exempt purpose. IRAs don't have an exempt purpose. Their purpose is to make money. So unfortunately, the UBTI tax can apply to a larger selection of IRA investments than potentially a tax exempt like a charity. So again, anything that involves margin to buy stock, non-recourse loan to buy real estate, or when an IRA invests in an active trader business through an LLC, not a corporation, anything over $1,000 could have UBIT, which can go as high as 37%. So that's why from a real estate standpoint, if you're investing in a real estate fund, you're going to want to ask, hey, is there leverage, which 99% there is. Any real estate fund will use leverage, right? And then the issue is, okay, if there's leverage, what is there net income, right? If the K1 shows net business income, you may be in trouble. If in box 20, there's a code for UBIT, yeah, you're going to have to pay it on a 990T. Your IRA pays the UBIT tax, not you, and it's reported on a 990T each year. And it's only if the UBIT's over $1,000. So the distinction between passive and active for real estate is super important. It's the difference between tax deferred or tax free in the case of Roth, or 37% tax as a maximum tax rate. So it's quite important. And that's why it's super important to work with experts, self-directed experts. I'm not BSing you guys. 10 times a week, I get calls from people saying, Adam, I used this IRA company a couple of years ago. They set me up with an IRA. They never, ever, ever told me about UBIT. And I read one of your blogs, your books, or saw your videos, listened to your podcast, and I'm freaking out because I think I owe UBIT. And in some cases they do. The only thing that saves a lot of these people is the statute of limitation, which is a 3-year statute. So if the activity finished 3 or years plus ago, you're in good shape. But if it's an ongoing activity, it's tough. And now it's tough to unwind it. So I'm of the belief that it's better to be informed up front because you can fix things before you invest and you can restructure, right? How do you get around UBIT? And that's probably a topic for another YouTube live, but you can use what's called a C Corp blocker, which I'll talk about in a bit. Actually, I'll do it in another video, or you can also do you can structure the investment as debt versus equity, or you can do a foreign blocker corp, which a lot of the larger funds do, where you can go through the Cayman Islands, which is tax exempt, and have your IRA through Caymans invest into the fund. But that's only for large funds will have a foreign blocker. Smaller funds will not have it. So there you go. Okay. You want to be passive when it comes to real estate. I'm talking IRAs. Forget about what you do personally. In that setting, you may have different circumstances. Your tax advisor may want you to be passive, Schedule C, versus active, Schedule C, versus passive, Schedule E. In the IRA world, you want to be passive. You do not want to pay UBIT tax, which can go as high as 37% when you have over $1,000 in net income. It's a very low threshold to hit the maximum tax rate. It's around $25,000. So you do not want to be there. You want to do everything you can to stay passive. And that includes restructuring if you have to. There's leverage blocker, or if it's just a matter of, hey, let me be smart about when I'm doing flips. Let me be smart about my strategy. Let me show that the flips I'm doing is part of an overall investment strategy. I'm going to put some money in equities. I'm going to wait a little bit to do flips. I'm going to show my intent is different than being an active business. So there's things you can do. And if, again, clients of IRA Financial, have this information, and we're happy to kind of customize it for each person. But something to keep in mind, because the worst thing you can do is do an IRA investment and get slapped with 37% tax. It's a killer. Okay, it's stupid. You basically should be doing it then with personal funds, not your IRA. And again, I see this issue 10 plus times a week, and it's painful. Okay, so you don't want to be in that situation. If you are in it, hopefully we can get you out of it. If you're not in it and you're contemplating a new investment, talk to someone. If it's not IRA Financial, it's fine. Talk to a tax advisor. When you're speaking to someone, make sure they know what they're talking about, right? Try to talk to a CPA or a tax lawyer. Not all lawyers know this stuff, right? Out of 23,000 clients, I probably have 1,000 plus lawyers that are clients, right? Just like I'm a tax lawyer. If you ask me a question on immigration law or maritime law, I'd have no idea what you're talking about. Okay. And I would not be the right person. Just like if you want to get a patent and you come to me and say, Adam, you're a lawyer, you can do it. No, I can't. I'm a tax lawyer. I'm a master's in taxation. It's what I've been doing for 21 years. That's all I know. Okay. And the IRA world, I've been doing it 12 plus years. So there's a lot, even though there's only a few sections, 49, 75, 408, lots of case law. There's lots of IRS rulings, notices, and announcements on the subject and on various self-directed subjects. So there's companies out there like IRA Financial and other great companies that have the expertise. Use them. Make sure you're working with the right people and have the confidence, because the most important part is the structuring up front. Once the investment's done, it's not much I can do. But you want to be speaking to me or other experts in the area before you do the investment, so you can structure it properly, hopefully get around UBIT, and hopefully keep your investment passive. So thank you so much for watching. Really appreciate you guys spend some time with me today. I try to do YouTube Lives every Wednesday, but with the summer coming up, there may be some weeks where I'm not going to be going live. So subscribe to our channel. You'll get the inside scoop. You'll know when we go live. And there's also great videos. We have, I think, almost 1,000 videos. We drop 3 to 5 videos a week. You can also watch my podcasts. If you don't want to listen, you just want to watch them on YouTube, it's easier. You can do it anytime you want. It's all free. So there's some really great content that I'm super proud of. So check it out if you're interested in this area. I promise you'll be a smarter investor. And you don't have to watch all 1,000 videos. No way. I wouldn't want to bore you to death, but there's probably a handful that you can get some really good info out. And there's various, if you're into real estate or cryptos or precious metals or other important or interesting investments, you can check those out. So thanks again for watching, spending some time with me today. Have a great day, and talk to everyone again soon. Cheers.